All right, Stephen, where should we begin, man? I got so much stuff in my mind. I got pages, I've got this, I've got things behind me. So Stephen is doing a quick video. So I'm just going to kick this off. You know what? Damn it. I can't sit any longer. I just can't do it. So folks, here's the deal. Are you gambling with your retirement? Seriously, are you taking a gamble with your retirement? What have all of you been taught to do with your money? You've been taught to give up control of your money. You've been taught to put your money in the bank. And not only that, even me, my grandmother taught me when I got a good job, ask if they've got one of those fancy dancy 401k thingamajiggers, as Bubba Brown would say, and put your money in that. And, oh, and by the way, Chris, ask if they match, because if they match, you got yourself a good company. And put as much money as you can into that 401k. See, grandma didn't know what we know. Grandma was taught, and her parents were taught, to give up control of their money. See, folks, this isn't something new. Giving up control of your money, this isn't a decade old. It's not, 20 years old. This has been around for probably ever. Wall Street, big banks, and many others have always wanted you to give up control so that they control your money. Okay, it's not new, but it can be changed very easily. The retirement gamble is this. You have been putting money into retirement with one particular goal in your mind. Someday, I want to retire, I want to stop working, and I want to enjoy my life. In other words, in saying that, what you've done is you've said, okay, for 30 years of my life, I'm not going to enjoy my life, and I'm waiting till I'm older when I retire, and then I'm going to enjoy my life. In other words, that's kind of what they got us believing, that we're going to retire, we're going to say, see you later, work, we're going to pack our stuff, we're going to go home, we're going to go to the pier, and we're going to sail off in our sailboat, and life will be good forever. We're never going to run out of money. We're never going to have to worry about anything, because that's what retirement is. That is a lie, a huge lie, because let's just look at this right here, the retirement gamble that I drew on the board here. So you put up 100% of the money. I want you to think about this. You put up 100% of the money in your 401k. You take on 100% of the risk, and you get 30% of the return. How many's in? How many of you are in? You guys like that? 100% of the money. You take 100% of the risk, and you get 30% of the return. Come on. Who wants it? Who wants that 401k? Stephen, you want that 401k? You want to take on 100% of the risk, put 100% of the money in, and only get 30% of the return? I know some of you are thinking, dude, that's not how it works. Bullshit, that's not how it works. That's exactly how it works. You get to keep 30% after fees and taxes. Hell, I'm not even rolling in inflation in there. I'm being a nice guy today. That is the retirement gamble, but it goes so much further. Let's look at statistics. Half of all Americans don't have enough money to save for retirement. Half of Americans. But you're not the half, folks. I already know you are the 5%ers. So I don't need to worry about the half. I need to worry about the 5%ers. But some of you might fall into the 1/3 of all Americans have next to no retirement. How many of you are close to retirement and you don't have much saved? And you're just like, well, I don't know, God willing, that Social Security is, hopefully that's still going to be around. It's going to keep me out of poverty. I know a lot of people in my own family, and I hate to say this, my mother, my unconditional one, this is my mom's plan. God willing, Social Security will keep me out of poverty. She's got an ace in her sleeve, right? Because she did the retirement gamble, but she had an ace, and that ace is me. I am going to be my mom's retirement plan. But how many of you want to do that? How many of you want to subscribe to that? Because you know what that is? That is, I hope, okay? You have to save 10 to 15%. Write this down, folks. You have to save 10 to 15% of your total income in order to even have a shot at having a successful retirement. How many of you can do that? How many can save 10 to 15%? Most of you probably can. Again, I already said you're the 5%ers. Let's talk about the 95%. Probably 99% of the 95% cannot do this. So are they doomed? No. There's hope, or at least we hope there's hope. Okay? If you make $100,000, you're going to need $1.5 million in order to have a shot in hell. But you see, you got a lot of headwinds. Stephen, you talk about these headwinds. Can you just bring up like the 3 biggest headwinds all Americans face, especially retirees when it comes to their money? What are they?
Yeah, absolutely. And before that, I mean, what we're saying here, according to the IRS and all these official statistics, I mean, this is stuff that is put out, but we've also experienced it, Chris and I, in our own lives. Like, I was a financial planner coming out of college, and I was meeting with families that were planning for retirement, planning for college, and finding what they actually had saved, what they were saving, the lifestyle that they lived, and the lifestyle that they wanted in retirement. Guess what? It was not going to happen the way that they had planned 95% of the time. So then I had to have the conversation. You need to drastically reduce your lifestyle. And as a financial advisor, hearing that over and over again, right out of college, it just really made me realize, like, man, there's got to be a better way out there. And that's what led me to my first real estate seminar. Actually, I went to a free seminar, and that's what ultimately led me down the path of being where I am today. And I quit being a financial advisor about a year later, got into real estate investing full time, and then into the training and education side of the business. But it just, this was real world stuff that led me to realize at I was fortunate to learn it at a young age. Hey man, there's a whole nother financial world out there of entrepreneurship, of alternative investments, of real estate, of private funds that nobody tells you about. And I just got out of college, so I should have known all about it. Never teach you any of that stuff. And Chris, you did it for 16 years. And I know you have, very, very, very similar stories of, your clients you were meeting with on a regular basis. I mean, it was rare to find somebody that was actually in a position where they were going to actually meet their goals, right? And the beautiful thing about what we do now is we can meet somebody that's coming close to retirement, or maybe they're planning, they're 10, 15 years out. They don't have to drastically change their lifestyle now or their retirement goals. They just need to change one thing and not work any harder, not do anything different, just reroute where that money goes first, and then reroute what they're doing with that money and keeping that money moving for them, getting that lazy money they never even knew existed, that lazy things like equity in a home, things like get that money out there in a new investment. So this is real world stuff. I just want to reiterate that this is not just, things we read in books. Although Chris is absolutely right. We know what we're talking about because we study history, we study economists from books, but this is also real world applications. And what Chris is asking about, the things that really, the headwinds that really stop people from achieving these goals. I mean, is really, we call it the three enemies of stopping wealth. And number one is, just inflation. Number two, we're looking at taxes, and number three is, what am I trying to say here?
Well, you got inflation, you got taxes, and what's the third headwind? There's actually a lot more headwinds than just that.
Right, I'm trying to see what we're going to be going at today, though,
because we got a lot of stuff to cover. But like those are two really big ones. I mean, market risk, interest rate risk, those are headwinds. I mean, There's lots of big headwinds.
Yeah, I was just trying to see. I mean, there's so many things that can happen. And I mean, when we start talking about, markets going up and down and riding it out, I mean, we'll get into this today too, like how that just doesn't actually make sense. Buy low, sell, buy low, sell high, and don't lose money. Like, why ride that thing out when we know what's coming? Like, let's get ready for that right now. And let's eliminate these headwinds. Let's prepare ourselves. And that's how we're going to create success moving forward.
Absolutely. So here's the thing, folks. The headwinds that you're facing, just like the board shows, and I think, can you guys see this board okay? You can see my little drawings of this guy that says risk. Stephen, can you see that, or should I zoom in a little bit closer?
Yeah, no, it looks good. It looks good.
Okay,
yeah.
Great. Yeah. Mine, it looks really small. So right here, some of the risks that you're facing are number one.
The word I was looking for was volatility, just so you know, volatility.
Oh, yeah, and that's exactly what I'm going to hit, number one. Yeah,
that's the markets, right?
That's why I said market risk, volatility.
Yes.
Headwinds. Markets are experiencing a huge run-up. Why are the markets going crazy right now? Has anyone ever thought about that? There's several components, and I want to help you understand maybe some things that aren't applicable, but just so you understand why this is happening this way. So why are the markets rallying? Well, last year, the markets crashed, right? We had a 35% crash when COVID hit. In February, the market started trailing down, and they didn't stop for about a month and a half after, until they found the bottom. That resulted in a catastrophic 35% loss. So when people lost money last year and it started coming back up, they're like, I thought it was going to be a bad one. I thought that was going to be a doozy. But people were scared when that thing was going down. But what people don't understand is that was catastrophic. A 35% loss. Folks, all of you, think about last year. This is just a year ago, folks. We're only in April right now. Last year in April, we were in the peak moments of COVID when the market was collapsing, businesses were shut down, America and the world was shut down. This is only a year ago, folks. 35% is what you lost. So if you lost, let's just say 10%. Let's say you had a diversified portfolio and your retirement account, your investments only lost 10%. Not a big deal. Because if you lost 10%, the drawdown effect would say if you lost 10, you only had to make back 11. And you did that pretty quickly. But how about for some of the less fortunate last year that didn't lose 10? Because I bet you any money, a lot of the people on here did not lose 10%. If they were listening to me, they probably did. But if they weren't, which most were not, because they didn't believe what I was saying was the truth, they probably only lost 30%. So a bunch of people lost 30%. Do you realize if you lost 30, you had to make back 43%? Folks, this is just math. This isn't me making this up. This isn't statistics. This is math. If you lose 30%, you have a 30% lower balance. That means that lower balance needs to work twice as hard almost, and it has to make 43%. So a lot of people last year, when they lost 30 and they were watching the markets come back and the markets got back and the news was like, oh my God, the stock market's back to where it was at its highest point. Just remember that? It was all over the news. My gosh, everywhere in the news. Stock market makes new highs, beats the 2020 high point. Everybody's like, oh my God, this is amazing. And then you get your quarterly statement. You're like, that doesn't look amazing. Your statement didn't reflect what the news was saying. You're just like, well, wait a second. Hold on, honey. We lost 30% and we're still at a loss, but the markets are saying the markets are all back and they're higher than ever. Why are we not seeing that? It's called the drawdown effect. You lost 30, which means you had to make 43%, but you see some people didn't lose 30. Last year, and especially in 2008, any of you that are old enough to remember the Great Recession, some people lost 50. And you realize if you lose 50, you got to make 100% to get back the 50 that you lost. Do you all understand this? So what Stephen was talking about is one of the biggest risks being volatility. Do you understand that volatility is something that will keep most people from hitting the retirement goals that they want? Not because they're doing anything wrong, but because they're doing everything they've been taught to do right. Let me repeat that. You're not going to hit your goals because you're doing anything wrong. You're actually doing everything you've been taught to do your entire life, which is exactly why you are facing these headwinds. Everything right that you've been taught is all wrong. And it's wrong because they didn't teach you the right things to do. They taught you what they wanted you to know so that you kept giving up control of your money so that they could make more. And we're going to talk about how much more they made than you did. How do I know this? Stephen knows this too. We were advisors, folks. I have to go to sleep every night knowing I spent 16 years on the other side doing what I tell people not to do today. That's a tough thing. But you know what's funny? As hard as that is to go to sleep every night knowing I did, not such a great job for a lot of people, not because I was intentionally trying to do something wrong. It's because I was brainwashed to believe what they taught me from the top. I go to bed every night with this, but without that, without living that side, without doing that, I couldn't do what I do today. Do you realize that, folks? Every single failure in your life is one step closer to the next success. Every time you do something wrong that results in a failure, it's just preparing you for what's coming. So let's get into it. Market volatility. Markets are experiencing huge run-ups. People are buying high right now. Why are they buying high? Euphoria, FOMO, fear of missing out on a return. But let's really talk about why else. Are interest rates high or low right now? Where else can you put your money today to get a return on your money? Anyone? Where? Some people are saying real estate. Let's hear it. Where can you put your money to make a return today? How about the bank? Does the bank, if you take your $100, okay, and you put your $100 in the bank, are you making a good return on that? No. How about CDs, those swear words we call them around here, certificates of deposit? Where else can you put it? E-commerce, bonds. See, everybody that's learning from us is saying bonds. So I'm going to skip that one, but you're right. Bonds would be a great place, but most people aren't. CDs suck, share certificates, IBC. Every one of you have been around the campfire too long. You're actually way smarter than you all think. But most people, the 95%ers that are not on this training, you know where they're putting their money? The market. Why? Because that's what everybody else is doing. Jimmy and Johnny and the people we went to dinner with last night, they're all putting the money in the market. They're making a ton of money. Joe put his money in Bitcoin. And he's going to be a millionaire by the end of the year. You're following the herd. You're being sheep. You're conforming. You're doing exactly what they want you to do. And you know what's going to happen when you buy high? What is the next thing most people do? Sell low. Because interest rates are so low. So I'm going to go to number 3. Interest rates are so low right now that because they're low, people can't get a return that even paces inflation. Therefore, they have to go to the higher risk assets, which are real estate or markets or Bitcoin or crypto or any of those higher risk ones, right? The volatility part. That means you're taking on more risk. When you're going away from guarantees and you're going toward higher returns, you're chasing higher risks. And that comes with consequences. How about the population? So why would aging population be a headwind for us? Well, let's think about it, right? Baby boomers are all retiring. And baby boomers are starting to retire. And when people retire, what do they need to do? They need to take distributions. They need to take money out of the market. They need to move things around. They need to do things that protect their assets, or they should. They're not right now, but most of them should. And in doing that, what are they doing? They're taking money out of the market. When money comes out of the market and more comes out of the market and more strains get put on the market, what happens? Eventually it goes down, does it not? Aging population is a headwind. Retiring baby boomers is a headwind. There's not enough new people putting money in to support the money coming out from the baby boomers, but it's just beginning, folks. How about long-term care? Like all those things. Those are other big headwinds, but we're not going to go there. Last, Stephen hit these dead on. The fourth headwind, and there's more, but the fourth headwind, government debt. Is the government creating a little bit of debt? Yeah, I think I just read it's 56% of the GDP, over half. The interest pay, it's sick, folks. It's not even sustainable. So we're not going to go there. You already know that the government's risky right now. They're taking on excessive risk by printing a lot of money, but they're doing it. Why? To drive inflation up, not to protect you. Oh no, they want to pay that debt down with that weaker dollars later. Brent talks about this all the time. Brent Kessler, if you don't know who he is, he's here today. He talks about this all the time. Like they want you to get weaker dollars later so that they can pay their debt back with weaker dollars. It only makes sense. How many of you would like to pay your debts off at 50 cents on the dollar? Your debt just went on sale. Well, all you have to do is drive inflation to do that. Make your dollars weaker. And what else? Taxes. Are taxes going up, down, or sideways? I used to say that in our speech, right? Well, how many of you think taxes are going up? Or are taxes going up or down? And everybody would say up, but now for certain, I don't even know if I'm even include that in my speech anymore, because all of us know taxes are going up. They got to bail this government debt out. So if all these are the headwinds you face, what else are you facing? Stephen, how many people, when you talk to them, talk about fees?
I mean, it's one of those things. They're kind of in the background, hidden. You don't really see them. You know, do you know the exact amount of fees that financial advisors and funds can charge that they don't even have to disclose? Do you know the number?
I don't. What is it?
It's a lot higher than you would think. So I was wondering, I forget the exact number, but it's in like the 30 to 40 range, like all these little fees that they can charge that they just don't have to tell you about. And those fees eat away and eat away and eat away. And it's something that most people don't even think about or consider.
You know, here's the interesting thing. And folks, what I'm going to show you next is going to piss you off. If you don't already know this, and even my 5%ers on here probably don't know this. This is something that took a lot of digging, and I was here early doing this. You guys can't really see this, but you see this. This is the SEC website, Securities and Exchange Commission of the U.S. government. Right on there, how fees and expenses affect your investment portfolio. So if you want to fact check this, just go there. I actually have the websites right here as well. You guys can go to www.sec.gov and just go in there and just put in / fees and expenses. And you can see exactly what I'm going to teach you, but save yourself that because it's a boring website. Let me just show you. So how many of you own mutual funds? Can I have anyone on here? Can you tell me in your 401k and your IRA, how many of you own those mutual funds? Let's see. How many of you have mutual funds? And let's actually throw ETFs in there because, you know, I know ETFs are better than mutual funds, but they're still a creature of the same device. Yes. How many else? Jake owns mutual funds. Angie's got mutual funds. Listen, like, most all of you probably have mutual funds. Unless you've been around our campfire for a while, I bet you any money, most all of you have some, or maybe even a lot, of mutual funds in your 401ks. Why? You don't have a choice. That's why. Your 401k that's offered by your employer that they give you that match from, guess what they give you the option to invest in? Mutual funds. What else is available in your 401k? How many of you can buy individual stocks inside your 401k? I'll bet you it's less than 1% of 1% of the people on here. How many of you have ETFs, which this should just be a common thing? How many of you have ETFs available in your 401k? Maybe 5% or less. That's a damn shame. So the only option you have in your 401k, and just so everybody knows, the number for how many people have money in 401ks, I wrote all this stuff down, is it's crazy. It's like 85% of all people have 401ks in one form or the other. About 44 trillion, I said that right, $44 trillion in this country have their money in 401ks. And this, what I'm going to show you next, is what nobody's being told. All right, last question, we're going to get into this fee part because this is going to piss you off. All of you that have 401ks, IRAs, or any type of investment account where you're investing with somebody else, your financial advisor, your broker, whatever you want to call them. How many of you, and be honest, please, how many of you have read the prospectus front to back? Come on, let's hear it. If you guys have that, if you guys have a variable annuity, the prospectus is thicker than the Bible. So I know none of you read it because the typeset is so small, you'd need double powered glasses just to read it. I know somebody just said, ha, that's a joke. Nope. Nobody's read the prospectus. Why? Is it because it's above your head? Is it too hard to understand? Is it just not a good use of your time? Or is there just not good information in there that you need to know? Because if you said there's just not good information in there that you don't need to know, you're wrong. Everything you need to know is in that big, giant Bible-looking prospectus that probably today is only emailed so that you can quickly hit delete because you don't even want to look at it. And in that prospectus, we'll tell you all the things you absolutely should have known before you invest. But here's the funny thing about retirement plans. 401ks. 401ks are the only product, period. The only product that Americans buy that they do not understand. None of you bought your lawnmower because you didn't understand what the lawnmower does and how to operate it, right? No, you all know how to do that. None of you bought a car because you didn't understand what that thing does, right? But the 401k is the only product, because it is a product, make no two ways about it, that Americans buy and they have no understanding of what it is. They don't know the price or the quality of their 401k. How many of you know what your 401k talks? How many of you know what your 401k costs you? Seriously. How many of you know the quality of the 401k provider or the funds? Again, probably less than 1% of you. Plus,
and I was just gonna say, Chris, and that's another thing. Like when you have a 401k, you're limited to, what funds that 401k provider allows you to pick. And financial advisors are the same way. A lot of people are like, no, this guy's managing my money and whatnot. But no, I mean, I worked for Ameriprise Financial, which was American Express Financial Advisors at the time, and they were transitioning, but we couldn't sell other, outside funds or steer people. Like we had to pick what funds Ameriprise offered to their clients that we could pick from. So it wasn't even like we were really going in the best interest of the client because we were so limited in what we could actually recommend. It's just stuff like that. It's just like, man.
I love it. And Brent Kessler says it best. And I remember the first time I heard this, I'm like, you know what, son of a pup, he's right. He says, well, how much he asks a whole group of people in the crowd. He says, so let me ask all of you, what do you know about your 401k? And then before anyone even says anything, he says, hold on a second. Let me tell you what you know about your 401k. He says, here's what you know about your 401k. You know whether you invested in conservative, moderate, or high risk. Maybe. And then he says, I think he pretty much says that's all they know, but that's pretty much what people know. They don't know anything about their 401k, but they know that if they go to work and they put their money into their 401k, they might have a chance, a hope that they can retire someday. Oh, and they might get a match. So now let's really look at what that 401k is, because no one understands it. Nobody understands the dangers. Very few of you, if any of you, are reading the prospectus, which holds all the answers to what I'm about to show you. And somebody had mentioned Vanguard, and I love that they mentioned Vanguard. Now, listen, I might be beating up on mutual fund companies right now, but I will tell you, I have a tremendous amount of respect for the gentleman who started Vanguard Funds. Vanguard Funds is an indexed fund family. That's all they have is indexed funds. okay? With the lowest fees, quote, well, some would say nowadays it's not, but they used to have the lowest fees in the industry on mutual funds. So Vanguard, if you have them, you're a little bit better than what I'm about to show you. So here we go. Let's talk about fees. Mutual fund fees. How many of you have a variable annuity? You don't have to even tell me because I know you're probably embarrassed or you just have no idea what you have. I used to sell a lot of variable annuities. You know why I sold variable annuities? I was told to. You know why else? Stephen, did you ever sell those things at Ameriprise?
Yeah. They tend
Why
to
did
pay
we
pretty
sell
good
them
too.
though? What was the biggest driving force that our brokers and our consultants told us? What was the big thing after they told us how sweet these shitty vehicles were, but how they painted this great picture? What was the last thing they would always tell us?
Well, they tend to pay pretty
And
good.
yeah, you get paid a big old rip, right? A big old commission, 4%, 6%. So think about that. The advisor takes your money, rolls it over from that old 401k from that old job, moves you into a variable annuity. They know they're getting paid 4, 5, 6, maybe even 7%. Do the math, folks. On 100,000, that's 4,000, 5,000, 6,000, $7,000. How many of you would be okay making that by suggesting a product? But what they don't realize is how much they're hurting their client, because annuities are the worst of every one of these we're going to talk about. And then ETFs and et cetera. So let me talk about the different things that most of you don't see when you look at it from a fee standpoint.
And
Go ahead.
one thing, Chris, real fast. One thing I do want to just put a caveat on all this, okay? If somebody, it's just reminded me that somebody said they've been with Ameriprise over 25 years. So if you have a financial advisor now, if you've been with a financial planning firm, we're not saying that's a bad thing, okay? What we're saying is for some people, that's fine. But guess what? Odds are not in your favor that that's going to turn out well for you, okay? But I also understand that being able to spend a couple hours a week to learn something new, being able to spend a few hours a month to implement a new strategy. Not everybody has what it takes to do that. So, it's not hard to I'll give you one example. It's not hard to join our private money club, spend 30 minutes on the phone with me, helping decide, what might work, going out, finding a place to invest your money that's going to pay you great returns. It's going to be secured in first position by a piece of real estate that's going to stay strong. So it's going to eliminate a lot of the risk. It doesn't take a lot of time to do that. You stick the money in there, whether it's a retirement account or whatever, and it's going to sit there for the next 3, 4, 5 years and you're good to go. You don't even have to think about it again. But it took 3 to 5 hours of education and implementation to set that up for the next 35 years. Not everybody's willing to do that. So I just want to say that, if you don't mind taking the risk of, hey, let's hope that this works out for me, or let's hope that my financial advisor has my best interest in mind. Hey, it works out sometimes, right? But if you really want to make sure that you're going to be able to live the life that you want, then those are the ones that we want to work with. Those are the ones that we want to keep on these trainings. We want you coming back every week. We want you to join us for our 3-day trainings, because you're the ones that we want to work with that are willing and understand that. So I just want to throw that caveat out there real quick.
Very important. Very important. So, back to the fees, because I'm not done pissing you off yet. I'm just warming you up. I'm prepping you. I'm like getting you ready for what's coming. So what fees do you pay that you didn't read in that prospectus? Commissions. Yeah, you guys are like, oh, we already know about that. You and Steven get paid commissions on those banking policies. Indeed, we do. Markups from your broker dealer. What are those? Sales loads. You know what those are? Surrender charges on those annuities, those IULs, index universal lives, or those variable universal lives that everybody loves to sell in the broker world because they get paid a big commission. Operating expenses, 12B1 expenses, 401k fees, they're buried. You think 401k fees are free, or 401k plans are free? They're not. Do you think the company pays them, or you do? You do, of course. The participants pay for it. Why would the company pay for something that they tout as being like the greatest gift they could have given you? No, you pay for those. M&E expenses. You guys know what those are? VA fees, investment advisory fees, management fees. I could keep going, but I'm just getting bored of even saying it. All of those. And what do those actually look like? What do those impact your portfolio? Well, let's look at it. Here's the examples of compounding fees on a $100,000 portfolio over 20 years. I just did simple math. $100,000 portfolio over 20 years. And again, there's my disclosure, folks. You guys want to see this? All this information I'm about to give you came from the sec.gov website. There's the sheet that I pulled all this off. I even printed it out in color because I was taking this stuff serious. So here we go. If you had zero fees, which you can't invest money, anyone know how to invest money without any fees? It's pretty impossible, right? So this is unlikely, but 100,000 is what you started with. Over 20 years, if all you made is 4%, and I conveniently picked 4%. Why? Because that's what these privatized banking policies pay you up to this year. How many of you remember from prior times of us talking about these privatized banking policies paying you a guaranteed 4%? You guys all know that, right? 4% guaranteed. How many of you know that that ends at the end of this year? Not if you already have a policy. That will be in perpetuity because you're grandfathered. But does everybody realize that at the end of this year, the government's 7702 will start being applied by insurance companies and the guaranteed interest rate is going to drop? Ding, ding, ding. The fire bells are going off. It's a fire sale. It is right. But that's where the 4% comes from. No fee. So your money, your 100 grand would have grown to 222,000 over 20 years at 4%. Not bad. Not bad, right? You went from 100 to 222. You didn't have to work any harder. Your money just grew at 4%. But I already told you it's pretty much impossible to invest your money, make a return consistently and persistently every day in the markets, okay, and do it with no fee. So let's just look at fees. 0.25%. This would be like maybe an ETF, okay, or maybe one of the really good index funds at Vanguard. Maybe it's 25 basis points. Your 100 would have grown to 210,000. So which means over that 20 years, you spent $12,000 in fees. And some of you are thinking, well, that's not too bad, Chris. Man, I wouldn't mind 25 basis points. But what was the future earning potential of that 12,000? Don't forget that. Remember, each year, actually each quarter or monthly sometimes, that fee comes out, which means you have less and less money growing. So even at a 0.25 basis point, you lost 12 grand plus whatever that 12 grand would have grown to. But let's keep going. How about 50 basis points, 0.5%? If you paid on your mutual fund, which I don't know many mutual funds except for index funds that pay or charge 0.5. And also too, when you are told, oh, the expense charge is 0.25, you're like, oh, cheap one. Don't forget to read the prospectus. Don't forget about the 12B1 fees, the broker markups, all the things mutual funds do that aren't in your best favor, but make them the most amount of money. Let's not forget about those. 0.5%, 200 would have grown, or I'm sorry, your 100 would have gone to 200. You gave up $22,000 in the future earning potential on 22. But now let's get to what's realistic. How many of you have had an advisor, because I know this is what I charge, that charges you 1% management fee. And then they take that 1%, let's just assume that's the only thing you're paying, which it wouldn't be. You'd pay 1%, plus you'd probably pay a separately managed account fee, plus you'd pay the mutual fund fees, plus the 12B1 fees. Okay, I'm going on and on. Stephen's going to fall asleep if I keep going with the fees. But just 1%. Your 100 would have grown to 180. That's a $42,000 haircut, plus the ability for what that 42,000 could have made. This is what you're taught to do, folks. Who's winning? If you earned a 7% return, let's get away from the 4. If you earned a 7% return on your money and you paid a 2% fee, and just so all of you know, except for you Vanguard folks, most of you are probably paying 2% or more. Any of you that have variable annuities, sorry, it's north of 2%. I don't know. Stephen, you ever do a variable annuity that was less than 2%?
No.
That's right. 2%. So we're just going to figure 2%. You know who came up with this right here? Not me. The founder of Vanguard. This is direct from his mouth. I just wrote it down. If you made 7%, you paid a 2% fee over 50 years. Over 50 years. I know it's a long time. You could break it down any way you want. You lost 2/3 of your portfolio. How many of you think 2/3 is a lot of money? Because if you don't, man, oh man, we have a lot more work to do if that's what you think. You would have lost 2/3 of your money. That right there is sickening. It really is sickening that that's how this works. And, you know, some of the rules to avoid these pitfalls are actually so simple. And I wrote them all down. How about the rule of 100? For retirement, the retirement gamble. If you're not planning to live to age 100, you are planning to fail. Okay, write that down. Rule number 1, if you're not planning to live to 100, you are planning to fail. Rule number 2, this used to be called the 4% rule. I call it the 2.5% rule. If you take out more than 2.5% from your portfolio each year, and you don't have somebody managing it and having a portfolio where you can take money from a safe place in down markets and all this, but let's just say you take more than 2.5%, chances are you're going to run out of money before you hit your final graduation date of 100 or whatever that is. Interest rate risk. Rates are low. If they go up, your debts potentially could cost more. Think about it right now. We're all using debt. All of us. Me, Steven, we're all using debt. Okay. And interest rates are really low right now. You're locking in mortgages. You're locking in car loans at close to zero. If interest rates go up and your next car you buy, you got to pay 5% instead of 0 with the Toyota finance company or whatever company's doing that. Can you afford that increase in interest rates? I don't know. Stock market risk. We already talked about that. The volatility risk. If the market next year drops 50%, are you okay? If the market in 2 years from now drops 60%, are you okay? If the market in 3 years from now drops 30, 40, 50%, are you okay? Can you weather that? Can you hold out? Most of you, 90+% of you, the answer is no, you can't. What would the brokerages and the big mutual fund companies say? It's just a paper loss. Just hang in there, just invest for the long haul. Bullshit, bullshit, and bullshit. You can't do it. Try it. How many of you tried doing that in 2008? Did anyone literally, and I want to literally give somebody the ability to literally be the hero today. Who on here today had money invested in 2008 and you touched none of it and you rode out the 2008 recession? How many of you actually can say you did that without taking your money and moving into cash, without, changing anything? Did anyone invest for the long haul in 2008? Lost everything. Jim did. Okay. So Jim is literally a superhero. Donna is a superhero. Who else? Julie is a superhero. I didn't touch their money then. Cindy, superhero. Of course, this would be that 5% group where a bunch of people didn't. But I bet you, we got 130 people on here. For all the people who are saying that they did, that's awesome. We got a lot of superheroes. You see, that is rare that those people held out through 2008, and actually could, because most people, fear hit them. They got really scared. They panicked. Reality set in. They lost their job. They couldn't afford things. They couldn't put food on the table, pay for their car payment, pay college tuition, and they pulled out, which means they sold low. Those superheroes that you just heard from were the ones that actually rode that roller coaster out. But now, one other question for all of you superheroes on here who literally rode that out, and you could say you did. How did it feel? How did that feel? In the moment when the market was down 40, 50%, were you thinking, holy shit? It was painful. It was scary. It sucked. They were in a very unique situation where they could weather that storm. But now, all of those people that rode that out, let's just say they were retiring a year. Let's say 2008 hit and they were planning to retire in 2009. How many of them could have let that money ride? None of them. They would have needed to start taking an income. These are the realities I'm talking about. And I know I'm going into this, but you got to understand the market is designed to take it back from you. You can't weather that. So the market, the stock market risk, is one that none of you can avoid if you're in the markets when you're ready to retire. That's why it's never going to work. Real estate. Okay. I'm not saying I think real estate is, and I want to be very clear and transparent. I think real estate is the greatest investment on earth. But I also think a lot of people right now are literally leading themselves straight off the edge of a cliff. People are paying stupid prices for investment real estate. I'm not talking about your primary house. Listen, if you buy a primary house in this market, listen, we all got to have a place to live. I would probably suggest not buying a house right now and renting a beautiful place until the market drops. And then you can go buy that same house you were going to overpay for 30 cents on the value. But some of you, like me, have a wife, and your wife doesn't want to hear that, or a husband, and your husband doesn't want to hear that. So you just paid overpriced value for the house. I get it. But real estate, people are jumping into real estate right now for the long haul. And they're going to all have to either do one of two things: sell when the market goes down because they can't hang on to it like people did in 09, 10, 11, and 12, or ride it out, suffer a little bit, painful, scary, awful, or some of the comments of what it was like riding it out. Just be careful. I still think real estate is the greatest investment on earth. Even if you're paying more for the property today than you think you want to, the numbers, the math, the rental, if that will weigh out what you're investing in that property, then good. But ask yourself, can you afford to cover some of the cost if things get hard. That's the thing. And most importantly, single-handedly, is Warren Buffett's buy low, sell high, and don't lose money. So when the market's going down, you should be buying. When the market, so everybody that was able to hold out through 2008, I hope that they were buying in 2008, 9, 10, 11, heavily buying. As much as they could put in, they were buying. I hope a bunch of you bought last March like I did, like Sodi did, like Steven did. We were buying when the market was going down because that's just what you're supposed to do. And when the market went high, what did they do? What did some smart investors do? They sell. A lot of people right now should be taking their gains off the table. You're foolish if you don't. I said that. Mark me on that. Your advisor is going to hate me for it. If you're not taking your gains off the table right now, that is foolish. It is irresponsible. It is you taking on risks you don't need to because of FOMO, because of the fear of missing out. So now that I beat all of you up and now I got you guys really fired up, and the numbers keep climbing, which is great. Usually when I piss people off, the numbers go down, but I'm hitting some really important pain bodies. I'm poking your bruise. And you know what? That bruise hurts every time I poke it. And that bruise is going to hurt a lot more when we keep poking it and keep poking it, but you're not going to realize the pain until the market crashes. And does the market go down faster than it goes up? Yeah. The market collapses. Why? We live in a digital age of little tripwires, of little domino-like things. When one goes down, the whole thing goes down. You won't be able to stop it. You'll get out a little too late. You're at the top of the mountain now. You're at the top of Mount Everest. Look around. It's beautiful. You're above the clouds. You can go anywhere you want. And that's what we're going to go into in the 3-day event this weekend. We're going to go into where do you go when you're at the top of the market? When you're at the top, and you take your money out of the market, then what? Where do you put your money? How do you protect that money? How do you still keep pace with inflation? How do you still beat taxes? What do you do? Steven, tell them a little bit about what we're doing this weekend. And I'll tell you something here that's going to be different about this weekend's. We have we have 2 special guests, and I want you guys to look it up. Steven, put it in the chat. Harry Dent Jr. He is a world-renowned economist. Don't ask how we got him to come on to this 3-day event, but you are going to meet and ask questions to the Harry Dent Jr. Okay. You can ask him questions about why he is 150% certain the market's going to crash. He will tell you statistically, factually, and historically why it's going to happen. And he will give you a very good indication of when it's going to happen, which I can't. He can't. He's an economist. And he's going to tell you all the places. This is the most important thing. It's not knowing that it's going to crash. I already told you that's going to happen. It's knowing what to do with your money when it crashes. It's knowing what to do with your money today to weather that crash. I can tell you what the people like the Ray Dalios, the Harry Dents, the James Rickards, I can tell you exactly what their portfolio looks like. Why? Because all of them look the same, except for maybe one of them has their money going to U.S. Treasury bonds. I love that people were mentioning that. And the other is a gold bug and loves gold. But certainly that's going to happen this weekend. You know who else is going to be on? Somebody that I never thought I could get. His name's Solomon. I probably said that wrong. Solomon. And you know what Solomon does? He works with extremely wealthy individuals and people just like all of you who might not be extremely wealthy to teach you what the wealthy do to avoid or minimize paying taxes through a very simple thing called trusts, foundations, and look this one up, 1041 tax reporting. All of you, your whole lives have filed 1040 tax reportings. How many, seriously, like I got to know this, Steven, how many people on here file their taxes on a 1041 versus a 1040? Is anyone on here filing a 1041? Because honestly, like we'd have a serious superhero. No,
I don't.
I don't. Not me. I just had to know.
I guess after this weekend, I might.
You know who does?
When is Solomon coming on? He's not on our schedule.
Yeah, he's on. I think the last day. He's definitely on the schedule.
Well, I'm just like on the website. We should get him on there.
Okay, Jim said, who knows? My accountant does that, which means you're not. You're filing a 1040. So Solomon's going to teach you how, and the only person I know that does this is Brent Kessler. And then aside from Brent Kessler, Warren Buffett, Bill Gates, the Clintons, I don't know, just any wealthy family you know file 1041s, not 1040s. Is it illegal? No. Is it illegal that Trump didn't pay much in taxes because he filed 1041s? No, not at all. It's fully legal. It's in the tax code. We just don't know about it. You're going to learn about that in the 3-day. So that will help you mitigate the tax risk. what else, Stephen? What else can we really kind of, I got a bunch of stuff that I want to hit today, but we got the first hour out of the way where I beat you up. I showed you what we were going to do. And now I'm going to kind of piece it together and lead you.
We have one question from the first half. Somebody just wanted to kind of break out the difference in variable annuities that supposedly are, packed with fees and have a lot of availability compared to indexed annuities that, do not maybe have the volatility. And maybe if you want to get into that, I mean, there's one chart I've always referred back to that kind of shows when you're looking at a 10-year time span. I think the most recent one is 2010 to 20, or 2010 and 2020 on Fidelity, but it'll show you like when you have so index annuities usually have a cap, so the money can go up, but they have a floor also where it won't lose money, right? In negative years. Do you want to talk a little bit about that?
Yeah. So let's just hit regular variable annuities versus indexed annuities versus fixed annuities. And I'll just write it down. So, we got variable annuities, which lots of people have. And most variable annuities that are sold today are sold with a rider called a GMIB or GMWB. Okay. Guaranteed minimum income benefit, guaranteed minimum withdrawal benefit. They tell you, and how many of you have a variable annuity and you were told your money can never make less than 6%? That's a lie. Your money can make less than 6%, but your income benefit, meaning if you annuitize the annuity and take an income stream for the rest of your life, meaning you can't access the money, you're not in control of the money, the insurance company's 100% in control of your money, and all you get is a monthly check for the rest of your life. No ifs, ands, or buts. Don't cross, go, or what is it? Don't cross go to jail, all that. Those are variable annuities with GMIBs. So
anytime you hear the word rider, just think fees too. Because anytime they're adding riders, you're talking money that's being taken away from you, not only control, but also you're losing money.
Yeah, they're usually about 0.5 to 0.8 bips, almost 1%, right? 0.5% to almost 1%.
It starts to add up.
What's the difference? So variable annuity can go right down to zero. You can lose everything. You can go down to zero. You can never lose more than what you put in because that's just how it works. But with the rider, your income benefit, so your income can't go below whatever that income benefit is, 6%. And I'll tell you something, there's a major headwind against insurance companies that were big on selling these. All I'll tell you is they're scared to death of this. Because when they have to start covering those income benefits, a lot of them won't be able to. And we're not talking about the insurance companies we use, folks. I'm simply stressing that that's a concern. So then we got indexed annuities. Indexed annuities are relatively newer. Okay, I actually don't mind them. I don't sell them. I don't want to. But indexed annuities give you some of the upside of the market to a particular cap, like let's just say it's 10 to 12%. And then you have limited downside protection, usually a floor of either 0% or sometimes you can't lose more than maybe 0.007. Okay, so you have a floor. So you have some upside potential called a participation rate. The insurance company invests in indexes. S&P 500, Dow Jones, Russell, all those, and they let you share in some of that upside with zero downside. But indexed annuities, just be careful of the fees. That's the only thing I'd say. Lots of fees in those things. They ain't giving you that freaking awesome, steak dinner for nothing. And then fixed annuities are something that I do a lot of. I do a lot of work with fixed annuities. So I'm not saying all annuities are bad, but fixed annuities are 100% guaranteed, have zero fees, but the downside of a fixed annuity is all annuities have surrender fees. So all annuities and the fixed annuities that I sell are only typically to institutional companies like custodians that need to make a return on money that they don't need today. So fixed annuities are great if you don't need the money today, you want a guaranteed return, and you're okay weathering a surrender charge over maybe a 5-year period. So that means that if you took all the money out, they'd hit you with some type of a small fee, 3, 4, 5%. So those are the three annuities. Hopefully that hits on that question.
And check this out though, Chris, real fast. Let me just show you, because the index annuity to me sounds great, right? It's got the floor, you get the upside potential of the markets, but I mean, I always go back to this because I always look at this stuff. This is right off Fidelity, so Fidelity actually sells these. So this is 2010, 2020, the S&P 500, and it shows each year what happened with the money. So if you look at, you took an indexed annuity over those 10 years, including the initial bonus that they give you, because they try and entice you to come into these, your money over those 10 years grew at 3.49%, when the actual S&P return with dividends was over 13%. So you're losing. I mean, you're losing money on these, and that's because of the volatility.
That is correct.
Some years are so high and some years are low. You're not actually getting the average or anything like that. And just it's so easy to make this stuff look good. And like you said, with the variable annuities, I mean, as a salesperson, and ultimately that's what financial advisors are. They're salespeople. I mean, as a Ameriprise financial advisor, new into the business, I was working 65 hours a week, and 50 of those hours was just doing cold calls, bringing business in, learning sales. And, it's great to sell these and you make a lot of commissions on them, but ultimately just all this that Chris is showing right now, it's just not like in the real world. This is your money. You need to control it.
Anyone want to take a guess on which one of those annuities pays the highest commission? Anyone? How about the first one, the variable annuity with the GMIB, right? How about second, indexed annuity? Why? Because the fees. What one pays the least commission? Fixed annuities. Very small commission, but no fees to you and a guarantee. So you can see, folks, like, don't always believe what you're being told, because what you've been told, most of it is the big lie that we talk about. I'm not beating up on advisors. I'm not trying to beat up on Wall Street. Well, actually I am, but I'm trying to help you understand that they're not out for you. They're not the cavalry coming to save you. They're in it for themselves, to make as much money off of you and to control as much of your money as they humanly can, because that's what they're in business to do. And they are not doing it very fair. They are not telling you the truth. And you know what else? Several years ago, I'll never forget this. There was this big thing where the government was trying to put in these laws that made financial advisors all become fiduciaries. You know what a fiduciary means? Literally, it's a piece of paper essentially that an advisor signs that says, I will work in the best interest of my client. I will become fiducially responsible for my client. There are fiducially responsible advisors. They're called RIAs, Registered Investment Advisors, and a lot of fee-based CFPs, Certified Financial Planners, are fiduciary responsibility or fiduciary responsibility. That's rare, but they wanted all advisors to be fiduciaries of their clients' accounts, which would put a huge liability on all advisors. And right when it went to Congress, Congress is like, well, that's not fair. We can't do this. It disappeared. That law, which was right there, was going to go into force. We even heard about it in the level as an advisor, and we were scared to death because we were all going to have to become fiduciaries. Then all of a sudden, lobbyists got involved. Something happened behind closed doors. Congress said, we can't do this, gone. Because it jeopardized the amount of money Wall Street can make on you. It jeopardized what the advisors could do and sell you, because they wouldn't be fiduciarily responsible, if I'm saying that right, for your money. Here's the end of the day, and then I'm going to get into some things that you have to do. Here's what it is. Nobody, I mean nobody, not the best advisor in the world, not the best RIA in the world, not the best banker, not the best anyone, cares more about your money than you do. So you should be the fiduciary of your own money. You should learn one, maybe two things. That's it. One, maybe two things to be in control of your money, to do one or two things really well, better than anybody else, because you've put the time in to learn these and do them consistently and persistently. I don't care if that's day trading. I don't care if that's options trading. I don't care if that's moving your money into a privatized banking policy, which all of you should do anyway, because that's the foundation. You change one thing and now all of a sudden your money earns a perpetual tailwind of interest and dividends for the rest of your life. I'm sorry, you don't even have to know how to do math. That sounds pretty freaking good. But I'm just trying to help you understand that you are your best chance to retire. The retirement gamble doesn't need to be a gamble at all. Not at all. If you just learn what to do. And what you need to do is so simple that most of Wall Street would say, there's no way that could be that. This is complicated. Investing money is tough. Indeed, it is, because they've made it difficult. What you can do is just simply be the bank. Join us for this 3-day training on this weekend. We'll show you all sorts of things, whatever flavor you want. You want grape, strawberry, lime, raspberry. We might not have one of those blended flavors yet, but we're working on it. We got all the basic flavors, and we're going to give you the ability to pick which flavor you want on how you want to handle your money. Maybe you're just like, listen, Chris, I want to be out and 100% guaranteed. How do I make money with zero risk? We got an answer for that. Okay, we're going to show you exactly what to do in the simplest forms. We're going to have you hear from leading experts, world-renowned economists, and people like Solomon who know the tax code better than probably the people that wrote the tax code. And you're going to learn from people like Chris Rood on mobile home park investing, which is what some would say a recession-proof place to put your money. How many of you want a recession-proof place to put your money if you know that there's a recession or maybe even a depression coming? All of you should say yes. All of them people that I just mentioned and a lot more will be in the 3-day this weekend. Oh, I know. Somebody's thinking, I can't make it. Loganberry, Cynthia, we'll get you some Loganberry. Someone's thinking, oh, I can't make it. Darn it, man, that sounds like such a cool event, but man, I can't. I got this going on. I got this birthday party. Great, we do a recording. And now when we send you the recording, it's broken down into little bite-sized sections, okay? So you get those little mini packs, right? Remember those with the little candies? You don't have to get the big bag anymore. You just get the mini pack that you just gobble up in one little sitting. We give that to you. So what are some of the things, Stephen? Let's get into this. Where people put their money to avoid the retirement trap? What can they do?
Yeah, definitely. And, somebody commented on here, we just wanted to understand, like, we're not selling whole life policies. We're not putting all these other things down for that reason. We're explaining how the real world works. And we don't even sell, this entire 3-day weekend, we talk about IBC whole life policies for 90 minutes of the entire weekend. That's it.
Let's be fair. Probably about 2 hours with my little bonus session.
Okay. About 2 hours. But because the thing with the whole life policies is we don't have to sell those. Those are once you understand how money works, then those are a common sense first step to take, as Chris said, a foundation to launch everything else that we teach you during the 3-day class. Chris, you've launched 17 businesses. I've had multiple businesses in the last 15 years myself. And there's a reason for that, because we understand how money works and we always are going to go to where we can make money. And being able to use our own privatized banking systems instead of now having to go to traditional banks to be able to fund these new businesses and these ventures just makes it all that much more profitable and keeping all that money within our family's systems, right? Our family bank now. So I just want to, make that clear. That's not why we're just trying to explain to you guys, this is the real world. This is why 95% of people don't succeed and retire with the goals that they want to. So I'm glad that Sean had commented on there, and it's very true. So at the 3-day, you just want to go through some of the different things we're going to be teaching.
Yeah. And I also want to be very clear about the 3-day. In the 3-day event, you are not going to be sold. Well, actually, I'm going to tell you one thing you're going to be sold in the 3-day. And that's the only thing we're going to try to sell you on because it only makes sense. We're not going to sell you anything. The only time you're going to be sold something for the 3-day is right now. And that's $297 to join us for 3 days with all these additional rock stars you're going to learn from. That's the only sale part. Because when you get to the 3-day, our intent, you're not going to come to the 3-day like you've been to those real estate seminars where at the end, right when you get to the good stuff, it's $30,000. You got to buy this coaching program. There is none of that, okay? There's the private money club, but I'll get to that in a second. No sales in the 3-day. It's our rule. What we do in the 3-day, we teach. We teach you how to be a good custodian of your money, how to be a good steward of your own money. That's what we teach you. We teach you the truth about money. We teach you what the wealthy do with money. We teach you what these wealthy individuals you're going to hear from are doing with their money, because there's not a person that is speaking that is talking about something that they're not absolutely doing themselves, and they're not selling you anything. If you want to work with them after, look them up. We'll give you their phone number, call them directly, set something up. There's nothing for you to buy at the 3-day. So if you're signing up for the 3-day because you want to buy something, well, buy a hat. They're $19.97 and we'll ship it to your house. Like, buy something there. The only thing we do sell at the 3-day is our new private money club, because that is like it's like eHarmony for dating, except for that's eHarmony for financial or for lenders and borrowers. You want to borrow money? Great. Get into private money club. If you want to be a lender to people in that club, great, get in. That's the only thing you'd be sold, but you're not even sold that. We just tell you about it. Most people work with us, not because they were sold something, but because they want to learn, because they want to avoid the retirement trap. They don't want to be a statistic of the 95% the sheep. They want to be lions like all of you.
Yeah. So, like you're saying right now, like, okay, so what do people do now? Like, okay, I don't want to stay in the stock market. I don't want things to drop. So what am I going to do with my money? So how do I start getting that out? How do I start moving that around? Right. So, somebody asked the question about, maybe we start with this, Chris, but, about the 401k, so this is a great example right here. their company matches 6%. Previously, they were contributing 12%. So the 6% plus an additional 6%. So 12% they were putting into a 401k. Well, that's a very easy first step to make. Drop that 12% down to the 6% if you're going to contribute anything into that thing still. But, there's nothing wrong with getting the free money from it, right? So if your company offers a match of 6%, go ahead and do the 6, get that match. It's kind of free money, even though if it drops, but it's still going in there, right, Chris? So go ahead and do that, but that's now clearing up a 6% that you can now redirect somewhere else. And then they're saying, once they did that, they went to go take a 401k loan, and they were told that there's a limit on the amount that they can borrow against their 401k. And that's a law.
50,000. Yeah. 50% or 50,000. It sucks. But a lot of people are always saying, oh, I'm just going to take loans from my 401k. And I say, it's very smart to do that if you follow the banking rules. But what most people don't realize when they say that is they can only take up to 50 grand out. Last year was a gift. We were able to take 100,000. Not anymore. Yep. So I'll keep going, folks. Well, he's tending to his dog. If you get a match in your 401k, we're not saying stop putting money into the 401k. Definitely reduce it down to the match. And then let's talk about where do you reallocate that to? I've helped a lot of people on here know how to navigate what's about to happen in the markets by simply doing one thing, and that's just reallocate your current funds in your 401k. We're not telling you to cancel. Actually, let me tell you not to do this. Do not close down your 401k. Do not shut it down and pay all the taxes and the penalties to the government. That's something you don't want to do. We want to use the 401k in your overall plan, but we also don't want to lose the 401k when the market does what we know it's going to do, and that is this. Okay, we do not want to lose that, which is why we're always talking about the floor. We got to create that foundation to your house, and that foundation is private banking. Okay, private banking, yes. Is it those specially designed and engineered whole lives? Absolutely, because that's your floor. It's your stable guarantee. It's where your money starts, because there's only one other alternative for where your money starts, and it sucks. It's called a bank. And I am really pissed off at banks right now because I can't even get my bank to answer their phone. I've called 3 branches today. Do you think I can get one branch to answer the phone? I've left 3 messages. Has anyone called me back? Nope, not a single call back. What do I want? I want to know the balance in one of my accounts that they haven't linked to my online banking. How many of you have suffered that? Is that where you want all your money in a bank, where you can't actually get somebody on the phone? I'll tell you, I'll make one promise to you. You call me, Steven, or anyone at the Money Multiplier, guess what's going to happen? We're going to answer the phone. We're going to call you right back, not back at the end of the week when you forgot what you called us about. You call an insurance company, you think they're going to just give you a voice recording? No, somebody answers the phone every single time. Banks don't know what the hell's going on. I guess they just don't have to answer the phone because they've got all of our money, which means they got all the control, which means we got nothing but waiting for them. Sorry, I'm going on a tangent. So 401ks are an option, but what if you have an old 401k, Steven?
Yeah,
what if somebody's got an old, like they worked at a company, they got this old 401k laying out there, and then, I don't know, almost forgot about that damn thing.
Or multiple old 401ks. I talk to people every day, every week that tell me, hey, I got 3 or 4 old 401ks sitting around. I'm like, all right, let's go ahead and call and let's start getting that money transferred. I don't even know who to call. Like, I don't even know how to access that 401k. That's literally, this happens. So that's money just sitting there. So yes, let's get those old 401ks. Let's do a direct transfer. If you don't know how to access that money, our partners in Horizon Trust, who is a self-directed IRA custodian, they will do this for you. They're very, very good at this. So they will go on 3-way calls. They have ways to research companies, other custodians, because all a 401k plan administrator is basically a custodian. And they all have different rules. Like I saw somebody else earlier, an active 401k, they took a loan, they paid the loan off earlier. They went to go take another loan to do it again. Guess what they were told? No, they were told they were only allowed to take 1 loan per year. You have to wait a whole year before you get it. So all these plan administrators have different rules. But anyway, so Horizon Trust can actually get on 3-way calls and find your money for you, do a direct transfer. Now, when you do a direct transfer, even if you're under retirement age, there's no tax consequences. There's no penalties involved. It's just moving the money from one bank, essentially one custodian, over to another bank custodian, where now you have control of that money. So getting that from now, an active 401k, 95% of the time, you are not able to do that. You're not able to transfer an active 401k to a self-directed. Now, if you're retirement age and you have an active, sometimes they'll let you at that point, maybe like 60, 62 years old. Sometimes they'll let you do stuff with it then, but otherwise you're just kind of stuck with that 401k. So again, either reduce or start taking the loans from it. But the old ones, direct transfer, no tax penalties. Now you have control of that money. Now we can have some fun with it. Now we can do everything that we're going to teach you during the 3 days with it and start growing that money and become the bank.
Right. See how I'm doing this? Like we could almost draw a big line in the sand here. These are all the things that you're not in control of. Your 401k, your bank, okay, accounts. But I can just keep going. Your CDs, all these things are over here. But
gambling. You have no control over, when you spin that roulette wheel, you got no control over what that ball is going to land on, right? That's the same thing with retirement. You have no control over any of that. Let's control it. Let's pick investments. Let's pick the risks that we want to take. Let's find things that are proven to grow our money and control that money the entire process.
Let me hit one thing about the active 401ks, 403bs, 457s. Let's say you're still working for a company and you're like, oh, I can't move this money. There is something, and Jesse just brought this up. There's what's called an in-service, meaning you still work there, non-hardship, which means you're not doing a hardship, an in-service, non-hardship rollover. You have to be over 50. So Jesse said 59 and a half, but you only have to be over 50. You have to have been with the company X amount of time, and the company has to allow it. If any of you are over 50 and you want to know if you can roll your 401k out of your active company into a self-directed, heck, you could even probably keep the 401k, just roll the assets in the 401k into your own self-directed IRA while still maintaining the 401k so you get the match, but you just don't want the money there anymore. It's call up your HR or your provider and ask them, do you offer in-service, non-hardship withdrawals / rollovers? And you can even type that in, Stephen, if you want. That is an option. And Jesse, thanks for bringing that up. Yeah, the other thing too that's important, somebody just said this. So not only, I guess, are banks not answering phone calls, somebody just said their financial advisor, who is a fiduciary advisor, isn't answering their calls. And I've heard that a lot lately. I mean, maybe they're just so busy. Maybe they're golfing more. I mean, things are so good right now, and the market's just going to go to the moon. They don't really have to do much. They just are along for the ride. And I'm not picking on advisors, but maybe that's why they're not answering the phone. Maybe they're just like, you're making money, we're good to go. A good advisor, a great fiduciary advisor. And how many of you can tell me you have one of these advisors? If you do, don't ever let them go. How many of your advisors spend more time focusing on helping you mitigate down market times versus calling you or doing stuff when the market's going up? If the market is going up, an advisor just throws darts, okay? But when a market goes down, or right before a market goes down, like what me and Stephen are trying to teach you, if you got an advisor that right now is advising you how to move your portfolio around, how to protect your money, how to get you ready for what might be coming, don't ever let them go. How many of you have a good advisor like that? Does anyone on here have one of those? A superhero advisor? Because I bet you not many people do. Yeah, your bank, nope. We'll just see if anyone says, because if you do, like, don't let them go. Right there, Rhonda has one. I think Rhonda's with Ameriprise. So she's got a good advisor that right now is obviously working with her on some of the things we're talking about on how to reposition, protect, and make sure she doesn't have to ride the roller coaster. There's very few people that have what Rhonda had. Yeah, only in my dreams is what most people would say. But hey, listen, they do work, they do exist, but they're probably so busy they're not taking new clients, because once they get an advisor, like once Rhonda gets an advisor like that, she's never letting them go. So these are things you're not in control of, folks. The 3-day event, we're going to teach you only one thing, and that is how to be in control of your money and what to do with that while you're in control. So you can see we can go from all of these different sources. We can move them to a self-directed IRA. Maybe you've got a company with, no employees, it's just you, but you want to put more money and you want to use your 401k like you used to when you work. Well, we can do a solo 401k. And also, just so everybody knows, we don't work for Horizon Trust. We don't get paid by Horizon Trust. We get zero zilch zippo. When you open an account at Horizon Trust, we gave up what they offered to pay us so that you don't have to pay for your account. I just want to be clear about that. And then over here, what are we going to teach you a lot of? How to be the bank. What is being the bank? Being the bank is, how many of you would love to be a private lender? And if you say, oh, that's too complicated, you just don't understand it. Every single one of you should want to be a private lender. You should all want to be the bank, because I'll tell you something. How many of you would be okay having a real tangible piece of real estate? Okay, I'm just going to pick on real estate. A piece of real estate backing and securitizing your loan. How many of you would like that? I would. I do. I love that. Banks love that too. In a first secured position, meaning if the person doesn't pay you, you just take the property. That's pretty sweet. So right out of the hole, that's way better than investing in Wall Street. Let's keep going. Let's go one more round. How many of you would like so let's put this, here's the benefits. First secured position. Not bad, right? Not bad. First secured. How about this? Fixed interest in excess of 10%. How many of you would be okay making 10% plus? So 10, 12% on your money, but that wouldn't be bad, right? I bet you a bunch of you would like that. How about monthly checks? How many of you would love monthly mailbox checks? Every month, a check shows up in the mailbox. And if the check doesn't show up, you pick the phone up and you say, hey, Mr. Borrower, you remember that first secured thing you signed? Do you want me to take the property, or can you just make sure that that check shows up in my mouth? Thank you. Yes, you forgot. I know. Mr. Borrower, let me make a suggestion. There's this thing called a bill pay that your bank offers for free. Set up a bill pay with my name on that check every month. Thanks, goodbye. That's how you react. Just did it this morning. I had a borrower who borrowed money, and the check didn't make it. He's like, oh, I got the check returned. I'm like, why? You didn't get the address right? I don't know what happened. Bullshit. So I sent it. So you just sometimes got to scare them a little bit. But monthly mailbox checks, how many of you would be okay with that? You see, all these things, these are things that only exist when you're in control of your money, when you're being the bank. We're going to teach you all about this. Not only are we going to teach you about that in the 3-day, we're going to give you a platform where this is just all there for you. People don't like going out and trying to find their mate or their partner in life. So what do? They go on dating sites. Why do they go on dating sites and all that stuff? I'll tell you why. It's easier. Everybody's in one place. You can read the profile. You can browse the menu without having to take any of that food home. You'd be like, yeah, I want that one. That sounds really good. The roasted cauliflower. Just joking. But you get it, right? That's why people do that. We created that. So this just got way easier. You're going to learn all about that in the 3-day. Listen, I keep talking about the 3-day because I'm jazzed up about it. Folks, if all you had to do to change that entire retirement gamble was change what and who is in control of your money and how you manage your money, and instead of me telling you how to invest the current monies you have in the markets, why not learn from Harry Dent Jr.? Why not have him tell you where should you put your money? And in what percentages? Harry, imagine this. Imagine if you could get on a one-on-one call with Harry Dent. You could say, Harry, I got one question, buddy. I got a lot of money in the stock market. I'm super nervous. I just heard this Yahoo guy, this guru type that calls himself America's #1 money mentor, Chris Naugle, and his sidekick, Steven. They were telling me about the market's going to go down. Where should I put my money? He's like, great. Put 10% here, 30% there, 35% there, 15% here, there. That's an all-proof portfolio. And here's why, and here's statistically, and here's what would have happened in 2008. Here's what would have happened in the dot-com crash. I got to breathe. Imagine if that's not worth $297 in some time, you're in the wrong place, folks. Go join the 95%ers because the sheep are out there. They want you. They're calling for you. This isn't your place. You're a lion and you want to be the king of your jungle and your financial future, and you want to lead the way. This is your place. This is where you need to be. And it's 3 days of your time and $297. And also, I don't know. Hey, Brent, are you still here? He might be on the phone, but if I can get Brent Kessler, my mentor, the one that taught us all of this stuff about banking, he's here and he's going to be teaching you on the 3-day as well. So I don't know what else I can say. Let's hit some questions here, Stephen.
Yeah. At top when we talked about John, you can hit finish on that. Somebody's asking where they can get the hats.
Go to chrisnaugle.com, scroll down. I think it's 3 swipes on the index finger, and right there, the shop. We just created it. We got a shop. You can get all sorts of shirts. We're going to pretty soon have a collaboration with Lions Not Sheep. You're going to be able to get Lions Not Sheep apparel through us. We hopefully eventually will have some BYOB and Lions Not Sheep stuff, but I'm getting ahead of myself. And also we're going to be giving away, Stephen, aren't we going to be giving away some Lions Not Sheep stuff?
I did see in the emails. I'm not sure what we got going on, but we're giving something away today. Yeah, I think we got a drawing.
We're going to do something today.
Where's Shauna? Is Shauna on?
I don't know if Shauna's not on, but I'm going to make this up as we go. So folks, here's what's going to happen.
She's there. She's there. You might want to let Shauna. Yeah, she said hang on.
How do we give away 5 Lions Not Sheep shirts?
we get yelled at by
Yeah,
Sean.
we got to be careful here. So see, she's thanking you. We're going to give away 5 Lions Not Sheep shirts to you. We got 120 people left, so hang with us, folks. And we're going to give those 5 away to people that sign up for the 3-day event. And Sean is going to figure out how to do it. Okay. So Sean is going to figure out how to give away 5 shirts to those of you that join us for this 3-day event. And Stephen, put the link up there again. And we're going to basically give you whatever Lions Not Sheep shirt you want. You're literally going to go to lionsnotsheep.com, pick the shirt, and there it is. There's the link for the 3-day. So if you're not enrolled in the 3-day, get enrolled. And any of you that sign up for the 3-day, we're going to pick 5 of you to give you a free, your choice, Lions Not Sheep, Lions Not Sheep shirt. But anyway, let's hit the questions while Shauna figures out how to do this.
Yeah. So one, I get this a lot. Like, what's the minimum amount to become a private money lender or invest in private funds? And, we work with investors. It depends the type of deal and whatnot. But I mean, I know in deals right now in the private money club, you could put $5,000 into.
Absolutely.
Make 10, 12%.
I would say that would be the minimum, because I mean, any less than that is going to be tough.
Yeah, anything less than that, you might want to look at some other strategies.
Yeah,
but
like
anything from that, if you want to fund a whole deal, I mean, I know of, Lori and John's deal right now. I mean, that's 97,000. Somebody needs, and they're willing to pay 12% on that, and it's pretty short term, like 3 to 5 months. So that'd be a good one for somebody.
I think I've already got that one funded, but I mean, I'll offer it to anybody on here if they want to jump in on Lori and John's deal. It's stupid not to. I wish I had my money like not out in other deals. I'd be lending to them in a heartbeat. So let's see.
I've talked to so many people this week. I mean, we have just unbelievable deals that are in the private money club right now. And I know a lot of people that are getting money either finalized in their self-directed accounts or their IBC policies are almost ready to go, that are ready to start lending. So if anybody has money ready to go right now, though, let me know and we can connect you. I'll put my email on here also. Okay. So the next question, let's see. Yeah. Suggestions on best way to take out a HELOC. There's actually
about HELOCs.
Better alternative to a HELOC, actually.
Yeah. So what was the question? So suggestions, best way to take out a HELOC, or recommendation on who to inquire with, best rates, low fees, Google it. Jennifer, so here's where I'd start. For a HELOC, if you want a true HELOC where you go to a bank, they give you the equity in your home and you pay monthly interest checks to the bank, then you would probably want to look for community banks. So in your Google, in your town, look up community banks and then just start calling around. Call 3 of them and just ask them, what are your rates on home equity lines of credit? And how much of the equity in my house will you give me? Don't settle for anything less than 80%. And your rate should be probably 3% right now. There's a lot of teaser rates at like 1.95%. So I hope that helps. But Jennifer, join us for the 3-day and we'll show you how to get the equity in your house. We won't. Matt will from Quantum RE. He'll show you how to get the equity out of your house without any monthly payments ever being paid to anybody, without any loans ever being created. All you do is share in the future appreciation of your house with a big group of private investors. So if you want to learn how to tap your equity in your house without any debt and any monthly payments, well, come to the 3-day.
Yeah, and understand what a HELOC is. A HELOC's debt. So like you're saying, we'll teach you a way to be able to tap into that equity and not have the debt aspect.
Lewis has got an easy question. He said, if I'm unable to attend the 3-day, that happens. And it wouldn't be surprising to me that you are unable because it's only a few days away. You get a recording. Remember earlier I was saying you might have come in late. Shauna takes extensive time in breaking up all the recordings of your 3-day into bite-sized pieces and segments of each speaker. So if you just wanted to get the 3-day just to hear about those 1041 tax reportings, then you would basically you just get the recording sent to you. The only thing that's not recorded, now this is very important. So if you're scheduling for this weekend, the bonus session, which will happen usually around 2:30, 2:45, the Friday and Saturday, we do 2 bonus sessions. I think, correct me if I'm wrong, Shauna.
Yeah, Eastern.
2 bonus sessions. Those are off grid, unrecorded, only for people in attendance because we get deep in the weeds and I'm not recording that. I'm sorry.
So the recordings go into our education platform, which is something called Teachable. So in your Teachable, whenever you register, you're going to receive a login. So you get your MSTV free 30-day trial. MSTV is just the value in that alone is worth the $297, just so you guys know, for the 30 days. So you get all access to that for 30 days for free. You get all the recordings. You get the file vault in the Teachable platform. So the file vault are all of the spec sheets and analyzing tools when you're looking at either purchasing a property, an investment property, or looking at evaluating one that you might lend on. So we give you all of those tools that Chris created, flipping 260 houses. You get all of that. And then you also get, Chris mentioned it earlier, but Horizon Trust charges $350 for a self-directed IRA setup fee. They waive that $350 if you come through our 3-day money school training program. So you get all of that stuff as well. And all of that's located, including those recordings, inside the Teachable database.
Yeah. And I love this. Jade just said she's opening an EQRP, which is just another version of what we've been talking about with self-directed. And she's moving, what is that? EQRP, and started moving IRAs into it. So isn't that just an abbreviation for the solo K?
Yeah, the qualified retirement plans, they're set up a little bit differently, but I believe they typically are treated the same way.
But anyway, same thing, Jade. So she's doing that, moving her IRAs in. She's like, next step. Well, next step is we got to get you be in the bank. And to be the bank, well, there's a lot of things we can do. You can buy a dairy cow and milk it in your garage and sell the milk, or you could lend to people like good borrowers like Lori and John, or some of the other people that are part of the private money club that we vet and make sure they're good borrowers. We don't guarantee that anything, but we vet them out, and we're going to basically give you access to all of them. So that would be your next step, Jade. And then Felicia, $997 one-time fee. It's a per year fee, Felicia. So each year it's $997 for the private money club. And that I'm going to be very clear about this. That is an intro rate. I guarantee you that rate will change in the future and not lower.
Yeah, because you're getting a 2-hour coaching call with us. You're getting support, all the support you need. We're helping with the perfect loan proposals and stuff right now. So there's just so much you get with that.
So did Shauna put a way for people to get the 5 Lions Not Sheep? She put an Amazon link for the Mapping Out the Millionaire Mystery, which I think is the audiobook. Is that the audio?
Oh yeah. Well, so I read the email earlier. If you've read Mapping Out the Millionaire Mystery, we would like to get some reviews on the Amazon page. So you don't have to give us a 5-star, but if you like the book, give us a 5-star review. But give us an honest review on the Amazon.com on that link right there if you've read the book, and then we will do a drawing to give away the shirts.
Absolutely. So there you guys have it. It's super easy. And, leave that to Shauna. That's why I kept my mouth shut, or Stephen was like, shut your mouth. Shauna, how do you want to give away 5 shirts? There it is. Go on that link that we put in there. I'll put it up again, folks. Go to this.
Maybe we'll do the drawing on the Q&A later.
Yeah, actually, that'd be a great idea. So anyone that goes to that link and leaves a review of Mapping Out the Millionaire Mystery, which is now available as of, I think, yesterday on Audible as an audiobook, you guys, if you leave a review, you will be in the running to get a Lions Not Sheep shirt of your choice. So folks, there it is. That's how you do it. What else do we got, Stephen?
What are builders doing about the spike in lumber?
Sweating. That's what they're doing. So that's a great question, Cynthia. What are builders doing? Well, I know builders, and you know what they're doing? If they sold houses like before lumber prices went skyrocket, a lot of them are trying to get out of those sales. And I know that's dirty, but they know they can sell the house for more because of increased labor, and the contract holds them to the price they set for those people. So they're trying probably really hard, and it's probably not good to get out of some of those contracts. Other than that, they're doing add-ons. Okay. Some of the contracts that builders have escalation clauses in there that allow them to increase the price if material costs go up. So if your plywood went from $29 a sheet to $110 a sheet, yeah, you're paying a lot more for your house. Let me give you an example. Me and Larissa, we're going to build a house. We're really excited. We had a nice budget, a budget that was the top of my budget. We went into the builder after we'd been working with them for months, had the lot picked out, had everything all picked out, like all the schematics done. And the builder breaks the bad news and says, hey, that price that you said was your ceiling. And he slides a piece of paper over and says, that's how much it's going to be now. The cost on all the building materials have gone up. I'm sorry. I said, I'm sorry too. We can't build a house. See ya. So then we ended up going out and finding somebody that really needed to sell their house, bought it way under market value, but now we got to remodel a house, and that sucks. So that's what we did. But yeah, that's what's happening. It's crappy. OSB, what did they just say? OSB went from $8 a sheet to OSB went up that much too. Can you imagine paying $42? Like, how are kids going to build mini ramps? Shauna, how are our kids ever going to build mini ramps like we used to back in the day? Man, it's just a crying shame. Screw houses, man. The mini ramps. The kids need the mini ramps. It's not kids need the books. They need the mini ramps.
I had to buy some the other day. I'm rebuilding a little transom on the back of one of my little boats, and it's just crazy, the prices right now. It's amazing.
500%. They're banks now. You're right. So does anyone know why lumber has spiked in cost? Can anyone tell me why, just in the final? Because we're just kind of wrapping now, folks. And I hope all of you join us for the 3-day, but why is lumber so high? So John just says Biden. Okay. Next, why is lumber so high? It's not, well, I don't know, I guess indirectly maybe, but can anyone tell me why? Yeah, tree houses are now McMansions. Darn right they are, man. Anyone that's got a tree house in the back, what you should do is literally sell the tree house, sell the rights, do a licensing agreement for people to occupy your tree house and charge $1,200. No running water, no toilets. Yeah. Nobody wants to take a guess on why lumber is so high? Nobody? Copper is up too. So lumber yards are holding stock. Okay, Derek, that's probably partly true. What else? Yeah, there you go. So right there, nailed it. Canada and COVID. So where does most of our lumber come from here in the States? Canada. Almost a huge portion of our lumber comes from Canada. And how many of you have tried going to Canada recently? I know I surf up in Canada and I haven't been able to go there in a year. The border's closed. We can't get lumber. So a lot of people would say, and I'm glad nobody did say this. Thank you, Jade. I'm glad nobody said inflation is the reason lumber went up, because it's not. It's supply and demand, because they can't get enough supply to support the demand. Housing's going crazy. Builders are building houses left and right, and lumber, they're probably holding some of it, but lumber prices are going up simply because they can't get it. It's just supply and demand. It's not inflation, folks. It's a form of inflation, but it's different.
It's two forms of supply. I mean, it's the supply chain. We can't get it. And it's also just the demand in the market. So the supply, I mean, is needed. Like the home prices where I live have gone so high that people are turning to, and there's just no inventory, that people almost have to build. So the builders, I mean, just the new developments that are going, it's unbelievable.
And does anyone know that, and I think Matt might be from Canada, but we have Canadian people on here. A lot of places in Canada are still shut down. Like they're still trying to contain, COVID, which I don't know. Steven probably has a little problem with that because he lives in Florida, and heck, you can go to Walmart without a mask down in Florida. I mean, and it doesn't seem like your numbers are growing too much. So I'm in New York, and we got to wear a mask everywhere except for outside now. They've loosened the reins on us a little bit. So we're actually allowed to go out and see the sun now here in New York. And that's a really good thing. So we actually are allowed outside, folks, so don't feel bad for us anymore. We can go outside. Restaurants are open in limited capacities, masks required, and they are not forcing vaccinations on us yet. So all is good here in New York. We are now allowed out of the cage. So folks, anyway, I'm done. I'm just going on rampant things here. So let's see. I'm 8 weeks from getting my real estate license. Do you have any quick tips to capitalize on that? Hurry the hell up, Derek, because this parade isn't going to last forever. And if you're 8 weeks, you got 8 weeks to start doing marketing, talking to people, and figuring out whose houses you're going to list or who you know is looking for a house. Because once this parade ends, it's going to be tougher than it is right now. So, yeah, folks, I don't know. Steven, anything else you want to say?
No, I mean, Derek, pick a good broker too. It can be important, having the right broker to work with and the right team. Other than that, no, I'm looking at the questions and the comments coming in. They're funny. No, other than that, I mean, it's, like we started out with, it's just, this is probably one of the most pivotal points in our lifetimes. I mean, nobody really predicted, except for a handful of people, what happened in this last, 06 to 05 to 08 with the market collapse and everything that happened. Even though all the signs were there, common sense told us that people working at Applebee's as waiters getting mortgages for 8 to 10 homes should not have ever happened, right? But it happened. But we went through it. We learned from it. Everybody knows what's about to happen right now. And I can't believe that more people are not jumping on learning how to take advantage of it. And just, it's amazing how easily we forget. I mean, it's easy to forget even just 12, 13, 14 years ago, how really, really devastating it was. And I truly, truly believe that what happens in the next 1 to 2 to 3 years is going to make that look like nothing. I mean,
Yeah.
I think that what's going to happen is going to be just devastating for so many people. And I just don't want you to get caught up in that. I want you, to do what Chris is doing, do what I'm doing, do what our existing money school members are doing, and prepare for it and get ready. And it's not hard. Again, this is not something that we're telling you to quit your job and go do this full time. We're not telling you to change everything you've ever done in your entire life. We're telling you to spend a few hours, spend a weekend with us, spend a few hours implementing some new strategies, and change 1 or 2 things in your life, 1 or 2 places that your money go first. And that will change everything. And that'll set you up, and that'll protect you for what is going to happen. Whether you believe it or not, it's going to happen. So just be ready.
Yeah. So the other thing too to understand is, Stephen just said something very important there. What's coming is going to be devastating. That's the easiest way to put it. But I want to clarify that. It's going to be devastating for the sheep, the 95% that conform to what everybody tells them to do. For the 5%, for all of you that join us for the 3-day and all of you that have been around the campfire, as Brent Kessler says, this is going to be the biggest opportunity of your life if you know how to play this game. So folks, to the opportunity seekers, to the thrill seekers, to those of you that want to be the bank, that want to make a ton of money and be the light in the darkness, this is your time. The next few years are going to be interesting, but they're going to be exciting. So welcome to the road, or welcome to the ride, I should say. And we're happy to be there with you. And we can't wait to see you this weekend for the 3-day, where we are absolutely going to blow your mind. And if you've been to the 3-day again, it's different, folks. Harry Dent wasn't on the last one. Solomon wasn't on the last one. So we'll see you this weekend. With that being said, we appreciate your time. And that is a wrap, I guess. I don't know what else to say. I had something else I was going to say, and I forgot right as I was about to say it.
That's a wrap. Lions, not sheep. BYOB. Check this out. Check this out. Ready? It's here, baby.
Oh my goodness. Look at that license.
Got the license plates going on my truck next.
We're going to end that right there. BYOB. And if you're serious, you get a license plate that says BYOB. Folks, have a good day. We enjoy your company and you being here and joining us to learn how to BYOB. And we'll see you at the Ask Me Anything happy hour, where we're all going to have a cocktail. Brent Kessler and Hannah Kessler in the house. We'll see you then.